Okay. Okay. Thank you. Welcome back. Now, so the other time, the time finished, and okay, that's just the first class. So, as I was saying, I was explaining issue and redemption of debt. All right. So, in my explanation, I was saying that okay, debt can be issued at premium, debt can be issued at par, can be redeemed at premium, it can be redeemed at par. At premium means it is issued at a price higher than nominal value. At par means it is issued at a price equal to nominal value or redeemed at a price equal to nominal value. At premium, redeemed at a price higher than nominal value. So the same thing goes for the last one. At discount. Okay, debt is issued or redeemed if the redemption price is lesser than the nominal. If the redemption, let me write it this way. If the redemption, if the redemption or the issue price is less than the nominal value. Okay, so that is when we say it is issued at discount. Okay, another one, very quickly, there is something we called spread. Okay, spread is okay. This is used to to compensate to compensate an investor for taking higher risk, to compensate an investor for taking higher risk. Okay, okay, it is the difference. It is the difference. It is the difference between it is the difference between it is the difference between risky assets or investments and risk free risk free assets. Okay, so I'm saying, what am I now? A Dangote Sugar is issuing a bond. Dangote is a normal company. The bond is risky. The asset is risky. Then government is issuing a bond. Government is government, all right? Their asset is not risky because Dangote Sugar can fold up. Government will not fold up. That's where we are saying risky. So whatever the government is paying is called risk-free rate. Then Dangote is risky asset. Okay. All right. So the difference is spread. Okay. And it is expressed in basis points. It is expressed in basis points. So when you see basis points, okay, e.g., 50 basis points, 50 basis points, okay, 80 basis points. So anytime you see basis points, right, divide the figure by 100. So 50 basis points, 50 basis points is equal to 50 divided by 100. 80 basis points is equal to 80 divided by 100. Then you add it to the risk-free rate. Okay, let us move on again. Now, I want to mention how you calculate the market price of debt. Now, market price of debts. I mentioned it the other time when I was stating the formula, when I say unit price. So how do we calculate that unit price? That is the market value of debt. And you can only do it for traded debts. You can't do it for non-traded. The value of non-traded is whatever it is in the book value, whatever the book value is. So market price of debt. Market price of debt, whether bond or debenture. Okay, it is equal to the present value of the future cash flow, future cash flow attached to the debt, discounted using the yield, all right? The followings are needed to calculate the market value of debt. Number one, coupon rate. This coupon rate, it is the interest you will collect. For example, if they say Geregu Power PLC, they want to issue bond and you subscribe to that bond, all right, Geregu Power PLC are supposed to be paying you interest on a yearly basis, all right, or every six months, anyone, or every quarter. They are supposed to be paying you interest. That interest they are paying you as an investor, it is because you borrowed power of your money. So they are supposed to be paying you interest. So that interest they are paying you is what we call coupon rate or coupon payments. Okay. Or coupon payments. Coupon payments. So you will receive the payment. Second is redemption value. Redemption value. When the bond you bought from Geregu Power, okay, finish, they will return your money back to you. At what value are they going to return your money back to you? Your capital, that's redemption value. So we need maturity period. Maturity period. So the bond you bought from Geregu Power is going to last for how long? 5 years, 3 years, 4 years, 10 years, 15 years, 20 years. How long is it? 2 years? How long is it going to last for? That's the maturity period. The last one is the yield. Yield. The last one is the yield. So these are the 4 things needed to calculate market value of debt. The first 2, which are coupon and redemption value, they are future cash flows. Future cash flows. Future cash flows. They are the future cash flows attached to the bond. Okay. So what are the future? You just bought the bond today. When are you going to receive coupon? Next in a year's time or in 6 months' time. In fact, tomorrow is a future. All right. So in 6 months' time or in 3 months' time or in 12 months' time, you are going to receive that is in the future. Then the bond is lasting for how long? The maturity is 5 years. At the end of year 5, they are going to pay back your money to you. And that year 5 is still in the future. So that's why we say redemption value and coupon payment or coupon you will receive is known, they are known as future values. So we are going to capture all these future values and bring them to today's price, all right? Discount them to today's value, which that is why we are going to use the yield, all right? And the yield or cost of debt. The yield is also the cost of debt, okay? And I've explained it before, okay? It is costs to the company you invested in, that is Geregu Power. It is yield to you who is receiving the yield from your investment, okay? It is return to you, okay, good. Literally, yield means return. Okay, so let us move on. Now, I want us to look at some questions, past questions from ICAN to explain how we calculate this market price. But before we do that, let us see, how do we calculate market value? How do we calculate cost of debt? Now, I mentioned the one for irredeemable. The formula is there, irredeemable cost of debt. And I mentioned the one for non-traded debt. But for the traded redeemable, I just said we are going to do yield to maturity. We are going to use IRR format. Okay, so I'm just going to list the things needed to calculate this cost of debt, yield to maturity. Okay, to calculate yield to maturity, YTM, YTM, yield to maturity, maturity, that's YTM. You need the following: one, coupon, coupon, coupon rates; two, redemption value, redemption value; three, market value of the debt, market value of the debt; four, maturity period, maturity period; five, we're going to need to assume two discount rates. Assume two discount rates. Now, in this case, you'll be the one to assume two rates, 3%, 5%. Just keep it simple, one digit. Examiner will not give it. All right. You are going to assume two discount rates, which is the cost of capital you would use to discount all the cash flows. Then after all this one is done, then you will now use IRR formula. So we are going to demonstrate it in a question now. All right, let us go to this question. So I have this question. Which is, okay, so I have this question, which is, okay, okay, wow, okay, this thing is gone. Wow, okay, let's do this. I'm going to show this question a little bit. Okay, it's going to be, so I'm going to read this question. I'm going to read this question. I'm just trying to share the question. Okay. Um, okay. Um, okay. Just okay, which is this. Okay. Um, okay. Just a minute. Um, um, okay. Um, um, trying to see how I can display this. Trying to see how I can display this. Okay. Um, okay. Let me go to my back to my whiteboard. Okay. Now, okay. I want to share the screen. I want to share the screen, which is so I'm going to be picking from the ICAN question, which is no May 2018 question 2, which talks about Kazaure Limited. May 20 question 2, which talks about Kazaure um, Kazaure Limited. Okay, talks about Kazaure Limited. Okay. Um, all right. Now, I believe you can see what I am sharing right now. Okay. Now, it talks about Kazaure Limited. Okay, it says Kazaure has a cash, that I'm looking at question 2. Okay. Kazaure has, this is May 2018, question 2. Kazaure has a cash surplus of 20 million, which the financial manager is keen to invest in corporate bond. He has identified two potential investment opportunities in two different companies, which are both rated A by major credit rating agency. Now, let me quickly say something about credit rating agencies. They are inside the investment world. So they help you, they rate companies, they rate assets of companies, they even rate countries. So they help investors to get insight to what is happening to the company or the country so that they know how the extent of the risk that they will be exposed to if should they invest in the company or should they go to the country to invest. So that is written, and it is actually a regulatory stuff. It is important. All right. Who is regulating them in Nigeria is Security and Exchange Commission, SEC. They also call them SEC in the US. Okay. So they regulate investment industry. So you sitting in your house, you saw advert on TV that come and buy Fidelity Bank shares. You don't know anybody in Fidelity. You just know that, oh, there is a bank called Fidelity and you want to go and buy their shares. So for you to have a little bit of insight into them, they would have forced Fidelity Bank to do their own rating and publish it. Okay, so once they do that, you see it on news, on their prospectus, their rating, and you read meaning into it. You ask professionals to tell you more about it. And you think, oh, if you think that it is too risky for you, you don't buy the shares anymore. If you think you can manage the risk, you can face the risk, then you go ahead to buy the shares. So it's just to gain insight. And there's the company like that, okay, they call them rating agencies, okay. We have the ones that are outside Nigeria. We have S&P, we have Fitch, we have Moody ratings. The one we have in Nigeria, they call them Augusto and Co. Okay, they are rating agencies. Okay, now let us continue reading the question. Bond A. Bond A issued Bond A. The issuer plans to raise 500 million naira 2-year bond with a coupon rate of 10%. Okay, bond the bond is redeemable at a premium of 8% to nominal value. That's bond A. Bond B, the issuer plans to raise an 800 million 3-year bond with a coupon rate of 12% and redeemable at par. Okay. Now, they said the annual spot yield curve for government bond is year 1, 9.5, year 2, 9.5%, year 2, 10.4%, year 3, 10.5%. Now, let me quickly explain this annual yield curve. Government too normally issue bond, and their own coupon or interest rate is called risk-free rate. Okay, so so it normally changes because these bonds are priced in the market. Okay, you can buy it in October, and by now you can buy a 2-year bond in October, and by now the price in the market is gone down. It's showing that you have made a loss, but don't worry, it's not as if it's just that the price at which you bought it has reduced. So, but in the end, they are going to pay you back your money that you used to buy the bond, as long as you are holding it to maturity. It's just that if you want to sell the bond now, you will probably be selling it at a price that is lower than the price you bought it. Okay, so that is what that one means. And it affects the yield and it affects the coupon. So that is why you can see that it is not the same figure year 1, year 2, year 3, but they are very, very close. Okay, they are not too far apart. Okay, then you see extract from major credit rating agency like Augusto and Co, like Fitch, like Moody, like S&P. Okay, website. Okay, table of spread in basis points. Now you can see in basis point. So the ratings are AAA, AA, and A, but the bonds we are buying, they are rated A. So the figure we'll be looking at 20, 30, 50. Okay, so the higher your rating, the lower the interest you are going to pay. You can see in AAA, you can see the figures are lower than AA. You can see the figure of AA they are lower than the figure of A. So the rating that has the lowest figure are AAA. It means if you are rated AAA, you will pay cheap price to borrow money in the market. And it shows that you are also credit worthy. And it shows that you are rated high. I'm just saying it just to be able to read some meaning into what we are reading from the question. So the requirement said for a nominal value of 1,000 naira, can you see? Requirement A, for a nominal value of 1,000 naira, calculate the theoretical issue price of the two bonds. Indicate how many of each the bond Kazuri Limited can buy, assuming invest in only one of them. Calculate issue price to the nearest naira. So now, forget about they say theoretical, they're just speaking English. Issue price is price. Price of bond is price of bond. It is what? the present value of future cash flows attached to the bond. So we are going to capture the future cash flows and we'll do the present value. And that's how we calculate the price of the bond. That's how we calculate the price of the bond. Okay, let us go back there now. So now we now say that. So how do we go there? We say, okay, now we have bond A. So bond A, okay, how do we calculate the price of bond A? Sorry, bond A. Now, bond A is what? What are the things we need? We need coupon. If you recall, we need coupon. Please, I would advise, as you are listening to this, I would advise you open the question from your end and be looking at the question. Okay. Now we need coupon. What is the coupon for bond A? 10%. Coupon is 10%, which is equal to 10 divided by 100 times 1,000 naira. 1,000 naira is one bond, equals to 100 naira. That is the coupon. What is the redemption value? Redemption value is equal to 1.08 times the nominal value, which is 1,000 naira. Now, why did I say 1.08? They said it is going to be redeemed at a premium of 8%, 8% of the nominal value. So 8% of 1,000 is 80 naira. Add it to 1,000, that is 1,080 naira. So we've gotten our two cash flow. What is maturity? Maturity is 2 years. What is the yield? Now, we are going to use the yield curve they gave us. We are going to use the yield curve they gave us, and we are going to use the yield curve they gave us, which is the government bond yield curve they gave us, and the ratings from basis point from the rating agency to calculate the yield. If you go back to the question, you will see where they say the annual spot yield curve of government bonds. Year for government bonds, year 1, year 2, year 3. Then you have extract from major rating agency. Okay, the bonds we are talking about here are rated A. Okay, so we are going to use A ratings, 20, 30, 50, year 1, 2, 3, respectively. So I would say year. So we want to do yield now. I will say year 1, 2, 3. Now, what is the risk-free rate? Risk-free. Those are the government spot yield rates. Year 1 is 9.5 in percent. Year 2, 10.4. Year 3, 10.5. Okay. Now, spread in basis points. Spread. Year 1 is 20 basis points. That is equal to 20 divided by 100. That is 0.2%. Year 2, 30 basis points. That is 0.3%. Year 3, 50 basis points. That is 0.5%. Add them together. Now, what do we have? That will be our yield. Year 1, 9.7%. Year 2, 10.7%. Year 3, 11%. 11%. So now we have been able to calculate the yield, and we've been able to get all the things that are needed to calculate the market value of bond A. So let us go to calculate the value now, the present value. Okay, so I move to the next slide. So I say year 1 and year 2. Okay, year 1 and year 2. Cash flows. What are the cash flows in Naira? Okay, year 1, 100 Naira. Year 2, 1,180. Those are the cash flows. And you will ask me, how did I get these cash flows? Go back to what we said here in the futures. Coupon is 100 Naira. For every year, you'll be collecting 100 Naira for every 1,000 bond. Every year, you will collect 100 Naira in year 1, you will collect 100 Naira in year 2. Now, so, and that is why I put 100 Naira in year 1. Then in year 2, you will collect 100 Naira and your money will be paid back to you. That is 1,180. And the money that will be paid back to you is 1,080 redemption value. 1,080. Okay? 1,080, the redemption value will be paid back, will be paid back to you. Okay? Now, then you also receive 100 in that year too. That total money that will be received will be 1,080. Okay, the discount factor. We have different discount factor for all the years. Year 1, that is the yield we are going to use. 9.7, 10.7, and 11% for year 1, 2, 3, respectively. So we are going to use 1 plus R raised to power minus n. Okay, so what is this? 1.097 raised to power minus 1. 1.107 raised to power minus 2. So R is the yield. R is 9.7. 9.7 divided by 100. That is 0.097. 0.097 plus 1. That is 1.097. The second one, R is 10.7%. 10.7 divided by 100 is equals to 0.107. 0.107 plus 1, that is 1.107. So I punch my calculator to get the present value right now. I say 1.097 raised to power minus 1 equals to this. I'm punching my calculator times 100. I got 91 in the nearest Naira. Let's 91.15. But in the nearest Naira, I will write 91. Okay, the nearest Naira. The second one, 1.107 raised to power minus 2. It is equals to this, then multiply it by 1,180. I got 963, approximately 963. So add the both of them together. 91 plus 963. I got 1,054. 1,054. That is the bond price. Bond price per 1,000. So that is for bond A. So very quickly, let us do the same thing for bond B. Now, bond B is going to happen this way. Calculation of bond B. Bond B. What is the coupon of bond B? They said the coupon is 12%. If you check back in the question, coupon is 12%, and which is equal to 12 divided by 100 multiplied by 1,000 Naira. That is equal to 120 Naira. Redemption. It is redemption value. Redemption, it is going to be redeemed at par, which is equal to 1,000 Naira. Then maturity. Maturity is 3 years. Maturity is 3 years. Then the yield, we have already calculated the yield. It's using the same set of yield for the one we did for bond A. Year 1, yield for year 1, 9.7%. Yield for year 2, 10.7%. Yield for year 3, that is 11%. Okay, so let us quickly calculate the market value of this bond B. I say the same way, we are going to use the same thing. So we'll say year, we have year 1, year 2, year 3. Cash flow in Naira. Coupon that you are going to receive in year 1 is 120. Check. The coupon here is 120 naira for bond B, 100 naira for bond A. Okay, coupon is 120. You will collect 120 in year 1. You will also collect 120 in year 2. You will also collect 120 in year 3 plus 1,000. Your money will be returned back to you. So the total money you are going to collect in year 3 would be your capital, which is 1,000, and coupon of year 3, which is 120. That is 1,120. Then very quickly, let us do the discount factor. 1 plus R raised to power minus N. This formula is called present value factor. In year 1, we are going to have 1.07, 1.09, 1.097, 1.097 raised to power 1, 1.107 raised to power 2, 1.11 raised to power, minus 3, 1.11 raised to power minus 3. Year 2 will be minus 2. Year 2 will be minus 2. So what is going to be our present value in Naira? The present value in Naira. Year 1, I'm going to do 1.097 raised to power minus 1 equals to this, multiply by 120. I have 109 approximately. All right, 1.107 raised to power minus 2 is this times 120 again. If for year 2, I have 97.9, approximately 98 naira. For year 3, I have 1.11 raised to power minus 3 is equal to this times 1,120. I have 819 approximately. Add all this figure together, 819 plus 98, all the PVs, plus 109. I have 1,026, which is equal to the bond price for bond B per 1,000. Okay, that is the price of bond B. Okay, the video will go off right now and we'll come back for the next video. See you in the next video. Thank you. Price of bond B, 1,026. Price of bond A was 1,054. Price of bond A, 1,054. Price of bond B, 1,026. See you in the next video. Thank you. Cheers. Bye.